More good progress in global growth and its support to our domestic economy, but the geopolitical situation is still an ongoing concern. An update on these competing forces and how our economy is reacting to them. As our Reserve Bank have noted in their recent board minutes and in a range of forums, the global backdrop is more supportive today than it appeared 6 months ago. So it's no wonder the RBA are more openly agreeing with the market that the most likely path in interest rates from here will be up, and so the easing cycle appears to be over. Given the work they are doing on property markets and managing the risks that are evident there, as well as the progress in jobs growth and the rebound in many commodity prices, further rate cuts do not appear necessary. And the latest jobs data did again show a jump in employment, this time up around 28,000 in July, pushing the unemployment rate down to 5.6%. However, as the chart also shows, there may be jobs, but wages growth is insipid. So the bad news is the lack of wages growth, but the good news is that this is feeding to low inflation, so is a factor in keeping rates on hold, delaying the inevitable path back to normalising interest rates. In a recent speech, the RBA talked about their calculation of what a neutral official cash rate is, which they estimate to be about 1.5% above current levels. And so low and steady inflation means both that this neutral rate is lower than it would otherwise be, and the RBA will see no urgency in actually getting there. This outlook is one of the reasons that business confidence is high, the prospect of ongoing low interest rates, together with a pickup in retail sales and the improvement in labour markets. But we are still seeing a divergence with consumer confidence, which is unusual as these measures are normally well correlated. Clearly, consumers are more worried than businesses about the geopolitical risks from abroad and low wages growth. And it does appear that household balance sheets are getting squeezed with rising energy costs, rising household debt, and the degree of underemployment we are seeing in labour markets. Again, at least the silver lining there is that despite the last RBA rate change being over a year ago, and their admission that the next move will likely be up, the timing of any rate rises from here is well down the track. And so, low interest rates should continue to add a degree of support and stability to stock markets and property markets. And finally, the Aussie dollar is trading quietly at 79 cents, a bit higher than the RBA would like it to be, but we'll see how it reacts over the weekend to central bank talks in Jackson Hole. The US dollar looks set for some volatility ahead, with the talk of US debt ceilings not helping. Until next time, that's the market update from Bendigo Bank.